Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from thewealthyhomeowner.ca. Welcome back to the show, Ross.
And thanks for having me back, Jim.
Ross, a listener in Alberta is asking if the rest of Canada is about to get the housing market Alberta has been experiencing because of oil prices.
Okay, well, that's a good question. So, that's a great question. Let's talk about Alberta. Let's talk about Calgary. Let's even make it easier again. People don't know. This has not been reported anywhere in the newspaper. But the average selling price, so the price that the average home buyer is paying in Calgary today, 2019, on an inflation-adjusted basis, is actually 10% lower than 2008. Here we are, 11 years later, and inflation-adjusted home purchases are costing home buyers 10% less than they were way back in 2008. Let your listeners let that sink in for a moment. Remember all of the crazy house price gains that were being talked about in Alberta in 2012, 2013, when that market was going crazy and the Calgary Real Estate Board was telling everyone that the market was just exploding. Here we are today, in 2019, March. The current selling price, year to date, in Calgary, is 10% below what it would have been on an inflation from February of 2008, 11 years before. You know, there's a lot of people who talk about Japan and house price stagnation in Japan, how housing prices in Japan have stagnated for 25 years. I just told Canadians, somewhere in Canada, a major province, a major urban city, Calgary, where house prices have not only stagnated for 11 years, they've actually fallen on an inflation-adjusted basis. Everybody talks about Canada's housing market, but you're not hearing anywhere in the news what's actually going on. You are not hearing about the wealth devastation that is taking place across this country right now. Alberta, British Columbia, Ontario have seen a record loss of net wealth over the last 12 months. Yet you have not read that in one newspaper in this country. You hear all the stakeholders trying to pretend things are okay. But I ask the listeners to think about this. There are homes in Vancouver that are selling 50% below what they were assessed at in 2016. 50% below. There are houses in Toronto that are selling for 35% below what they would have appraised at or sold for in 2017. There are houses in Calgary which 11 years ago you would have got more money for them. Sold it in 2008. Let all that sink in, because you haven't read those headlines anywhere in Canada. Why? Why has the public continually being kept in the dark about home ownership wealth, net wealth, the ability of the Canadian population simply to go out and spend money. Why? I don't know. I can't say, Jim, why they're happening. But this Alberta scenario gives everyone in Canada a wake-up call. Calgary home prices in 2008 and inflation-adjusted real values were 10% higher than what they are today in Calgary. I'm not even talking, folks, about the improvement in quality that has taken place over those 11 years. The massive new amount of homes added to the housing stock, which automatically raises the quality that home buyers are able to acquire. I'm just talking simply what home buyers are paying. They are paying 10% less today than they were 11 years ago in inflation-adjusted dollars. Of course, they're paying less interest on their mortgage on top of that. So where is the affordability chart for Calgary that shows affordability is better in Calgary in 2019 than it was 11 years ago? Where are all the bank charts showing this factual representation of the home ownership market to Canadians? It does not exist. So when we're talking about what's happening in the Canadian housing market right now, everyone only needs to go back and look at Alberta. Look at the city of Calgary from 2008 till 2019. 11 years, a 10% drop in real house prices, approximately a 17% in quality at the same time, and no one has heard about it. And then they wonder why Alberta has a hard time getting things rolling, or why the oil market is so important to Albertans, or why China cutting canola purchases from Canada is so important, is so hurtful. Realize at the same time, over the last 11 years, the value of Alberta homes has dropped 10%.
Ross, so the message is if you want an affordable home, go to Calgary?
No, the message is, Jim, all housing markets move in Canada exactly the same. All housing prices are going to be recorded as changing exactly the same. All of the complaints about affordability are rooted in mismeasuring the value of the average home in the marketplace. Let's look at Vancouver with those crazy affordability issues they talked about in 2016, 2015, 2014, 15, 16. Generation Squeeze Group in Vancouver, for the sake of the argument, Jim. The problem with the discussion is they were not measuring the housing market as if there were 3 times as many homes that you could purchase in a month. They were saying the buyers who were foolish enough to be buying a home at the worst time possible to enter a housing market were establishing the price of all of the houses in Vancouver, which was hogwash. It's nonsense. Those are sales techniques. Those are sales stats. Those are seller beneficial housing market metrics presented to the public in order for realtors to earn commission by selling houses at the highest price possible in the quickest amount of time. The problem you have is people don't understand how you can make a true house price model. Because you heard a whole bunch of people, I know that you had an academic and housing analyst claiming they were going to create a new house price model in Vancouver in 2016. Well, shouldn't everybody be asking themselves, where was that house price model? Well, you want to know something? The reason there's no house price model is probably because when they sat down and tried to create the model, looking for the homes that they were going to view apply to the model, simply reproduced the average selling price or the benchmark price that's already released. Of course that's what it's going to mirror. There's nothing that anyone can do with a standard house price methodology, from hedonic house prices, repeat sales, house price benchmark. There is nothing that you can do when you look at the market from that viewpoint to have anything other than what the average selling price produces.
So, Ross, what you're saying is, in Vancouver and Toronto, can we expect 2008 prices taking inflation into account?
100%. Like 100%. And the point of the matter is, Jim, this should be known by every economist or every academic or every housing analyst in Canada. They should understand these things. The only reason they don't is the entire Canadian home selling infrastructure has been built to support sellers getting the highest price possible. And there is such a canyon that you have to leap in the way that you process housing markets to get from a totally seller beneficial perspective that not only have you grown up with and received your education in and watched in news headlines your entire lifetime, but your parents grew up, experienced it, the same thing. And their parents before them, they all experienced the same thing. We're talking about an Evel Knievel leap of faith over the Grand Canyon for people to be able to understand that nothing that they understand about housing markets is true. It is myth, as we've said in the show before, Jim. The world, the housing market world, to everyone else is flat. To us, it's round.
We'll have more with Ross Kay right after this.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Welcome back. We're speaking with Ross Kay. Ross, tomorrow will be a week since you reviewed the new first-time homebuyers incentives in the federal budget. What are your thoughts on that today?
What my thoughts are is this, Jim. I have watched for a week as people and pundits, economists, academics, and realtors have gone on national television telling people what the first-time homebuyer incentive is, when in fact the government has not even released the policy. The amount of propaganda generated by this decision by the federal government to create a new first-time homebuyer incentive without having the policy set, it may be historic. We have seen the craziest assumptions being made and appearing in all major media across Canada. We have watched banks, economists, once again, making statements about the impact that this policy would have on the housing market, when the policy has not even been determined. We watched, when we saw in the national media, everybody said it was a 5% down program. Well, when we read it, we didn't see a 5% down. We saw a threshold of 20%. Now, that probably meant that 10% down cash plus 10% incentive from the government could be applied. But even that, we won't take into consideration that right now, Jim, because it would be foolish for the government to limit it to that. Because if the government says, well, you can put 20% down and still get the 10% down, but you've got to buy mortgage insurance, which normally you would not have to buy today. We would get what's called portfolio insurance, which is a buried cost in the posted mortgage rates consumers are never told about. But a long story short there is, what the government would do is they would be reducing their risk from the program. So why would the government say, oh no, we're not going to give it to somebody with 20% down, when in fact it would lower the overall program's risk profile? So it makes no logical sense to make that assumption. We are looking at the income level is set. They set that at $120,000. They set the maximum amount of mortgage that you're going to be able to carry with that to be equal to mortgage 4 times your income is equal to the mortgage and the incentive that they're using. Okay, so that's going to be set. That doesn't mean they're going to limit the value of the home that you can buy. Yet you see out there, people are saying, oh, well, that's going to equate to a $600,000 home. What are you talking about? That's not what the policy says. And the reason the policy doesn't say it is not a firm policy. It is a framework. It is a general understanding of a concept that the Minister of Finance has come up with as an election prompt. Over the next couple of months, they are going to formulate that policy into some hard numbers, and they will communicate that to the public to win votes. They are going to be trying to place the NDP and the Conservatives in a position where they have to cannot argue against the policy. They're going to have to accept it. That's what's going to be taking place. So for all of these people to be going on national news, communicating to the entire population of this country, all the millennial homebuyers who this policy is targeted to, that are being misled right now because people are guessing. It's just unfathomable, Joe. So what has taken place since our last, since we talked about this on Budget Day last week? What's taken place is the entire population of Canada has been inundated with propaganda, opinions, and guesswork. And they're asking the people who listen to this propaganda and guesswork to believe it. Don't believe it. Wait till the policy comes out. When the policy is fully comes out, we will be able to look at the policy and tell what its impact is going to be on the housing market.
And Ross, you're the one who pointed out, too, it doesn't go into effect until September 19th, which is just a few weeks before the election.
Yeah, exactly. Just before the election. And, I mean, not only that, Jim, what people should have seen today, what they should have been able to read today is what the outcomes of this are going to be. And that's not happening. Instead, people are looking at a framework. They're projecting their desire to gain national exposure for their businesses on television. You know, everybody asks, Ross, why aren't you on these TV shows? Why aren't you on there? Well, we're not on there because in a 5-minute soundbite, we can't communicate the truth to the listener. We would have to talk about talking points. We would have to talk in half-truths. The reason we come on House Street, is because we have the freedom to express our full commentary about the market. And at the same time, we have enough time that we can relatively protect our IP in our discussion. We certainly don't come on here and communicate everything that we communicate to our members. We don't come on here and tell listeners here what's going to happen 2 years down the road that we're able to tell our members. But we can come on here and we can try to help the Canadian public understand everything that they're told about housing today, virtually everything, almost everything. It's not true. It's a myth. And that is going to be debunked the same way, and like we talked about in the last section, Jim, over a long period of time where the reality hits everybody in the pocket.
We'll have more with Ross Kay right after this.
Grand Portage Resources recently completed the 2018 drill program on its 100% controlled Herbert Gold Discovery property located in the prolific Juneau Belt in southeast Alaska. Drill results are expected through late 2018. Past drill results included numerous multi-ounce gold assays on multiple veins. Grand Portage trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, we didn't see an increase of amortizations back to 30 years in the budgets or any changes to the stress test. Without those changes, do you see the market going in a different direction?
Yeah, I think that was really the lead-up conversation. And as we headed into the budget, pretty much everybody thought there was going to be an increase of amortization, a maximum allowed amortizations from 25 to 30 years on CMHC insured mortgages. I mean, I even believe that odds are Morneau was going to cave to that one. The pressure that he was under from the Canadian Real Estate Association, the Mortgage Brokers Association, Canadian Bankers Association, the Canadian Home Builders Association. I would argue, Jim, it probably was a record lobbying effort by those groups to try to get the government to increase amortizations to 30 years. But at the same time, Jim, what our concern was not necessarily in increasing the amortization to 30 years, but what would happen the moment he did it. Because I'm going to say something on the show today that hasn't appeared anywhere. We tweeted it out last week before the budget in our warning to Mr. Morneau. Well, of course, he's not going to be listening to us. But your listeners can watch what's going to happen now. The banks, the Canadian banks, are going to reduce their 5-year posted rate. They are going to effectively reduce the mortgage qualification rate from 5.34% probably to 5.14% over the next couple of weeks. We believe that this is what the banks are going to do. Banks are not booking the mortgage product that they need to be booking to keep their profits up and their CEOs happy. They believe that they can reduce, if they allow people to borrow more money, i.e., drop the mortgage qualification rate from 5.34% to 5.14%, that's going to stimulate the housing market. Well, I'm here to tell them it's not. Had Mr. Morneau reduced the increased the amortization limit to 30 years, and had the banks in tandem, one at a time, moved their posted 5-year rates down so they averaged 5.14%, then you would have seen added momentum to the housing market for a very short burst. You would have seen many young Canadian families enter the housing market during its correction phase, setting themselves up for wealth devastation in the years ahead. That's what was going to happen. Well, Morneau did not increase the amortization. Now the banks only have the manipulation of the mortgage qualification rate. What your listeners can understand is Mr. Rudin, from the OSFI, when he placed this rule into effect, he knew that the banks would try to work their magic against this rate. The bank's sole goal is profit. Profits are predicated on mortgage debt. Mortgage debt dictates household consumption. The banks are fully aware of it. They are trying to stimulate household consumption by manipulating the mortgage qualification rate. There is room right now, Jim, on the weekend. Supposedly, Toronto Dominion Bank dropped their 5-year posted rate by 0.7%. They dropped it below 5%. And then this morning, they supposedly said that was a mistake. I'll tell your listeners, I don't believe that is a mistake. Because if I was the bank, that's what I would be doing. If my goal was the profit of my shareholders at the bank, and I needed to book more mortgages, I needed housing prices to start going back up, I needed the illusion of a housing market getting busier again for me to get my bonus, that's what I would be doing. I would be manipulating the mortgage qualification rate. So what I expect to see take place over the course of the next 2 weeks is one bank truly dropping their posted 5-year rate to 5.14% or below. Then you will see 2 or 3 other banks do it. I believe I'd have to look at my policy again because I've got so many stats in my head right now as we're talking, Jim. I can't promise what it is, but if I'm not mistaken, if 4 of the 6 banks post at 5.14%, all of a sudden the mortgage qualification rate will be at 5.14%. They believe that is going to stimulate the market. Well, it's not. What it's going to do is some people on the fringes may be encouraged to make a last-minute mistake. But what your listeners can do is watch and see, because the Bank of Canada has not changed its interest rate. That means that if the bank changed their posted 5-year rates, they have made a business decision to do so. It is not being governed by a decision from the Bank of Canada. That's why we expect to see, this is why, but a long story short, Mr. Rudin had to add the 2% limit into the mortgage qualification policy. Because he knew if he set it at 1.1%, the banks would play that game. By setting it at 2%, he has prevented a lot of the damage that the banks are going to be trying to do to earn profits over the next couple of weeks.
Ross, thank you so much for chatting with us.
Hey, thanks for having me on, Jim.
My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. If you have any questions for Ross, you can send them to info@housestreet.com. Our popular YouTube channel is Talk Digital Network. You can find us on Twitter @Housestreet. I'm Jim Goddard. Thanks for listening.
Comments made on Housestreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. Housestreet.com radio is a production of House Street Media Incorporated.